Many of our clients find that they've saved more than they need to fund their core living expenses for a lifetime. So we start talking about proactively increasing their living and giving. Last episode, we talked about increasing living by taking family on special trips. This episode, we want to talk about efficient ways to increase charitable giving, the things to avoid, best practices, and helpful strategies that can make your charitable giving more efficient and fulfilling.
All right, so Spencer, today we're going to talk about tax-efficient charitable giving. As we walk with clients, we often start off with the curves of retirement. If you don't know what the curves of retirement is, we have a video that we'll link in the description below that you can watch, but really it's a helpful visual for clients to see where are their assets going over the course of their retirement. And so oftentimes when clients see that they're on a strong green curve, our encouragement is to do additional living and giving. Last episode, we talked about living and taking kids on special trips. This episode, we want to talk about maximizing giving and especially doing that in a charitable context. In the next episode, we'll talk more about giving to family. But today, why do we want to talk specifically about charitable giving and more specifically the tax implications? Why is that so confusing to clients?
Austin, there's a lot going on here. One of the things that we want to go back to is charitable giving is great even within the context of a normal financial plan. So it's not just that we give charitably when everything looks great, but we see as some plans continue to just go up and up and up, we want to encourage clients to think about bending that curve down a little bit and using resources during their lifetime to do additional living and giving. So there's a lot of different ways that we can think about this, but at the end of the day, we just want to make sure that more of those funds go to those core values, those priorities that clients have, which tend to be giving to loved ones, giving to charitable interests that they want to support, and maybe a little bit less to the U.S. government.
Mm-hmm. You know, and I remember this when the Tax Cuts and Jobs Act sunsetted. I was still working for a nonprofit organization. And for a long time, our pitch was, you can give to us and it's great, but you also receive a tax deduction because the standard deduction was a whole lot lower. And so for many of the folks that we were reaching out to, they were giving above and beyond that limit of that standard deduction when combined with their real estate taxes and income taxes and sales tax. And so they could receive a better tax benefit. But for us on the field, we didn't know that when the Tax Cuts and Jobs Act sunsetted, there was not as much tax benefit to that. And so really, I think tax planning when it comes to charitable giving can be really confusing because tax law changes. So what are some of the most important things to think about when we consider tax planning for charitable giving?
Well, we'll go through 5 elements here. And the first one is just to be intentional. We find that a lot of folks, the decision will be made year to year, and it will even be December to December. And as we look at that long-term approach to a financial plan, we say you have more than you need. As the old adage is, do your giving while you're living so you're knowing where it's going. So it's great to make charitable bequests, but it's even perhaps better to make those gifts during your lifetime. You can see how those are used over time, and you can continue to make gifts in that same vein if you think that the institution's doing a great job with those resources. So I think it's really looking at things and it's being intentional and saying, okay, my financial plan is stronger than I thought it would be 10, 15, 20 years ago. How am I going to use those resources as a steward of those? And so we think about that from a lifetime gift standpoint. How can I use those in a lifetime? But then also, what do I want to give charitably at the end of my life? So that first step is really being intentional. And that really dovetails with a second step, which is a long-term approach to tax planning. So as we get granular, we want to say, okay, not just what is my tax bill this year, but what might it be next year and the following year and the following year. And so we're in the midst of a tax law set of changes that is likely to happen in 2026. As you mentioned, we had the Tax Cuts and Jobs Act passed in 2017, so that law went in place in 2018. Well, we're going to see that sunset at the end of 2025 unless legislators make a change to that. So we have some opportunities before and after that in some different ways to do some planning. So we think about intention, and then we think about the long-term approach, but also how that relates to each of the next few years.
Right. And we look at it in the greater picture of a financial plan because we want to really hone in with clients. What are those goals? What are those desires? And it really is important to take that long-term approach. And like you were saying, there needs to be flexibility. If you are constantly giving right up to the standard deduction and not getting any benefit, well, maybe there's some ways that we can craft a financial plan for you to continue to satisfy your giving goals, but also receive tax benefit from it. So really, because we look at this in a greater financial planning process, we really need to be flexible. So tell us a little bit more about why we need to be flexible with this.
Well, we don't even really know on a year-to-year basis until after the year is done sometimes what the U.S. government's going to decide. So 10, 11 years ago, the legislators decided December 33rd that they were going to allow QCDs to happen. So, it's tongue-in-cheek, but it was like January 3rd, they said, oh, well, if you did it last year, we'll actually honor that. Well, that wasn't enough guidance to let anybody know that QCDs, qualified charitable distributions, would actually be honored that year. So we have to be flexible, and we have to say, well, we're going to do our best with this, but also know that Uncle Sam may have different ideas at any time during the year and may give a lot of guidance, a little guidance, or no guidance until after we really need to have made these decisions. So flexibility is key.
Yeah. So let's talk through the fourth and the fifth, humility and then prioritizing simplicity. Touch on humility for us.
Yeah, I think one of the things that we come back to oftentimes is this is so complex that if we're getting into a long-term approach, oftentimes it's really helpful to have other professionals be able to say, well, you need to remember this piece, or we need to remember this piece, or have you thought of this? And in this context, usually it's a CPA. Usually it's someone that does this on a day-to-day basis, that understands that long-term complexity, also can see some of the holes in maybe a simple plan, that we might create. So we want to include other professionals typically as we think about this planning process.
Yeah. Okay, and then that last one, prioritize simplicity.
Good grief. There is enough complexity in tax law, hundreds of thousands of pages of tax law that's out there. And so if we can, what we want to do is find ways to make sure that the plan is implemented in the simplest way possible. We'll go through a couple of different examples of how this can be done, but rather than set up some kind of complex trust that has to be, you have to jump through different pieces on an annual basis, why, if we could use a donor advised fund, for instance, and get just about the same benefits from it, a donor advised fund oftentimes would be far easier in terms of administration. So we want to, again, prioritize simplicity where it's possible.
Right. Okay. So we've talked through 5 important pieces of tax planning. Let's talk through some mistakes to avoid. We got 5 of these. So the first one is failing to incorporate estate tax planning for charitable giving. Who does this affect, and why is that important?
Well, it's this idea that if we're going to give money to charities at the end of life, let's do it with intention. And let's do it in a tax efficient way. Yeah. The number of folks that we sit down with initially who say, I would like to give some to charitable causes at the end of my life, but I haven't really thought through it as well, and maybe I haven't, set up those designations from a beneficiary standpoint or put that in the will in an explicit way. There's a lot of people that we sit down with initially. One of the biggest mistakes or shortcomings to that plan is that if we give pre-tax resources at our passing to charities, they don't pay tax on those. So if we have a traditional IRA, or we have a 401k, a traditional 401k, those kind of resources, those are ideal to pass on to charity, because if we pass on those resources, the charity is not paying tax on those. Whereas if we pass on those to a son or daughter, they're going to have tax that's going to be due on those. The number of times that we've seen an estate plan put together where there is resources that come from, say, the sale of a home that goes to a charitable institution, but son and daughter are getting all of the IRA resources, that can be tens or even hundreds of thousands of dollars that's sent to, again, the federal government for tax that doesn't really need to be if we just do this with intention and we optimize for tax planning.
Right. So I think a lot of people get tripped up on this as well, because they're thinking there's going to be a high estate tax when I pass away. Where are the estate tax exemptions, and how many people does that really affect?
Yeah, it's going to affect very few people, the estate tax on a federal level. And of course, we don't have estate tax at the state level in Tennessee anymore. But exemption is, I think, $13.61 million in 2024, and that's per person. So it's double of that for a couple when we look at the portability option that they have. So it's not the federal estate tax that we're so concerned with. It is pre-tax resources that could go untaxed to a charity, but because of a lack of planning, sometimes go to a son or daughter with other resources then that wouldn't be taxed to the son or daughter going to charity. So we just want to do that with intention.
Yeah. Okay, so the second one that we want to talk about, the second mistake to avoid, forgetting about documentation during your lifetime. So talk us through this mistake.
Well, oftentimes people will make a charitable gift, but they won't follow up with the appropriate documentation. We need to make sure that as you make that gift and you get that receipt from the charitable cause, that you keep that. It's especially important if you keep that, and let's just say you're aging and you keep that in a spot where your agent, your power of attorney would know where that is, just in case you're audited down the road and they're handling that audit. You would want to make sure that you have that available to them, but it's other things as well. It's if you have a qualified charitable distribution, knowing that you need to also keep that documentation just like you would a cash gift to a charitable cause.
Yeah, that's good. Okay, so the third one, giving primarily based on tax write-offs. So why is this a mistake to avoid?
Well, we don't want to put the cart before the horse. Let's make sure that you're passionate about the charitable cause that you're giving to. You're going to save pennies on the dollar. You might save 20, 25, 30 cents on the dollar, some other figure that might be in that range, maybe even as high as 40 cents on the dollar. But we want to make sure that you're passionate about the charitable cause that you're behind, that as we think about that extra living and giving, that you really know where those resources are going, and that is the driving force rather than just getting a tax write-off, because there are circumstances the government can change things and you might not get a tax write-off for one reason or another, whether the standard deduction is raised or the conditions are changed. We don't want to ever say, well, we're going to do this 2 or 3 years down the road, because the government could change things where that's not going to even be in play. The government actually could just get rid of all of the tax write-off for charitable gifts. There has been talk about eliminating the deductibility of charitable gifts. So we don't think that that's likely to happen in the next couple of years, but it's absolutely possible. So we don't want to do some kind of elaborate tax plan and think that we're just getting this tax write-off and that is the key driver. We want to make sure that even if we didn't get the tax write-off, that we'd be really excited for these institutions to get the funds.
Yeah, that's good. Okay, so the next one, the fourth mistake to avoid, is not understanding strategy trade-offs. Why is this important?
Well, it comes back to, we need to know at least enough to say we can do this or we can do this. We can know that one path or another, we're going to get some benefits maybe up front and we're going to defer some benefits down the road, or vice versa. We need to know enough about the strategy to understand the trade-offs that we face there. So it may be that we're looking at clumping gifts together, in a particular year. Well, if we're doing that, we need to make sure that we get all of those gifts made in that year and that we don't forget and make some additional gifts in January or the following December or whatever it might be. So if we don't understand the strategy itself, oftentimes we find the implementation is lacking thereafter, or we might get to a point where we didn't understand that actually one strategy was best in most circumstances, but if something came up with the government, it could invalidate that strategy. So we have to be comfortable with the idea that, okay, we think that there might be an 80% chance that this is the best strategy. It's going to save us 5 figures in taxes, but it could be wiped out by some kind of legislative action that could happen based on an election that we can't predict that could be upcoming.
Right. Okay, so the last mistake to avoid is relying on heirs to do the right thing. Why is this a mistake?
Well, what we want to do is we want to make sure there is complete clarity and that it's written into the beneficiary designations, written into the will, and that we're not just relying on heirs because you might have told a son that you want $10,000 given to your local church, but you didn't mention that to your daughter, and then there's conflict in terms of administering the estate. Or it could be that you said, well, I want to make sure that you give out of a certain set of funds to another charitable institution. But then son and daughter have different opinions because they say, well, if we gave from this vehicle, it would be more tax efficient. But again, there's conflict there. We want to make sure that everything is explicit and clear. Of course, there's also circumstances where you could tell everybody that you want gifts given to a charitable institution and them just not honor it because it's not written there. And it means that they're going to get, $10,000, $20,000, $50,000 less, and they might be pushing resources to an institution that they actually don't like, that you like.
Yeah.
So let's make sure that we've just got everything spelled out. It's in beneficiary designations, it's in a will, that you have a fiduciary responsibility of that executor or executrix to act on your behalf to carry that out, or that you've got it written in beneficiary designations and then the financial institution is held by law to send those resources to the beneficiary.
Yeah, that's great. Okay, so let's pivot now to looking at ways that we can actually practically implement this. So we've got 7 ways that we can give. So first, just directly giving cash to charities during your lifetime. This is the one that most people are aware of. You receive your income, you write a check, you put it in the offering plate at church, you give it to the local charity. It's fairly straightforward. Anything else you want to touch on that way to give?
No, like you said, it's very straightforward. If you have the cash to do it, if you have extra resources in the bank, wonderful way to do it. It's the documentation you just need to keep, like we've talked about, and you need to know that it's going to be deductible in that year that you make the gift.
Right. So the second one here is using a donor advised fund. So talk us through just a high level overview. What is a donor advised fund? If you want to watch a video that we've done about donor advised funds, we'll link that as well. But just give us a high level overview and what's the strategy?
Yeah, a donor advised fund is essentially a charitable piggy bank of sorts. You can put funds into that donor advised fund. You can push either cash or you can push appreciated securities there. Those resources stay there until you direct them to go out. Now, you are technically the advisor. You are not the owner of that fund, you're the advisor. So there is a little bit of a distinction there, but you get the tax write-off in the year that you make the gift, and then you can give that gift over many years to come at kind of whatever pace that you want to. So it helps to use a donor advised fund oftentimes to clump gifts together in a particular year if you want to kind of overfund your charitable gifts, so to speak, in a given year, but then spread out the distribution over time. The other thing that it can make it really easy is those appreciated securities. If you give it to a donor advised fund, they'll handle the accounting and make your life a lot easier than trying to give, say, your appreciated security to 8 different institutions.
Yep. And we'll come back to this one several times because we really like the donor advised fund vehicle. So put a pin in that one for right now.
Great.
So the next one is giving via a qualified charitable distribution. So you have to be at least 70 and a half years old. So talk us through the QCD.
Yeah, so the one thing about a qualified charitable distribution, we can't take from an IRA and push it to that donor advised fund. The qualified charitable distribution has to go out to an individual charitable institution. But for those, again, age 70 and a half and older, they can take out resources and push them directly from their IRA to a charitable institution. It does not go to their bank and then out to the charity. It goes direct to the charity. And what happens there is that distribution is not included in their taxable income if they do things correctly in their tax return. So what would typically happen is resources would go out and they're not going to get a tax deduction on those, but anything that comes from that traditional IRA that would otherwise be taxed at some point, be a pre-tax resources that's ultimately taxed as a distribution, it's not going to be taxed there, again, if they file their taxes correctly.
Right. And one thing that we will always want to recommend clients is keep those receipts for these qualified charitable distributions. Because oftentimes when you get the 1099 at the end of the year, it's not going to show what was gone to a qualified charitable distribution or what was gone to your bank account. It's just going to show the gross distribution. So it's really important to keep those tax documents handy.
Exactly.
Okay, so let's talk about the fourth one, giving appreciated securities. These are often done first into a donor advised fund, but you can give appreciated securities directly to charities. So walk us through this vehicle.
And this is really tax efficient because if you have resources that have had some real nice growth, let's say you invested in a stock that initially you put in $10,000 and now it's worth $100,000. Well, you have $90,000 of gain in that stock. So if you were to sell it, then you would have, in all likelihood, some capital gains tax that would be due on that. If you give it directly to a donor advised fund or give directly to a charitable institution, you get the full amount of the value of that security to write off for your itemized deductions and such, but you do not have any kind of tax that's due from long-term capital gains there, provided that it's a qualified gift and that you're within the limits and so on and so forth. You can only give up to 30% on an annual basis of your adjusted gross income there for that appreciated security gift. But again, it's very efficient to do it that way rather than to sell the security, have to pay the tax, and then make the gift thereafter.
Right. Okay, so let's talk about that fifth one, giving from an IRA at death. You can do this via beneficiary designations, and that beneficiary can be a charitable institution, but it can also be a donor advised fund. So talk us through this strategy real quick.
So this really brings together a lot of these different pieces. A donor advised fund is very helpful here because it can ease the level of administration. We have clients that oftentimes will name their church, for instance, and might have a small church that is going to get 10% of their IRA assets that they're passing. Well, oftentimes the church is not going to have someone that does this on a day-to-day basis. It may take them 6, 8, 10, 12 months to just get the account set up, to get the resources pushed out and withdrawn and all kinds of different things. And it just takes a long time for their administrator to do that. If instead you use a donor advised fund, instead of them having to set up that account, work to get it funded and then distributed and such, if you just name the donor advised fund as a beneficiary for your IRA, what happens is it's much easier for the donor advised fund, because they do this on a day-to-day basis, to receive those funds, and then you can direct those funds. You can have set up that donor advised fund such that at your passing, it pushes out resources to any number of different charities. So if you started and you had 5 different charities that you wanted to give to, then let's just say, to make the math easy, you had $100,000 that was coming from your IRA, and you wanted to distribute it evenly, then you'd have $20,000, going to each one of those charities, and none of them would have to set up their own account. They would just receive a check for $20,000. So it can make things a lot easier from that standpoint. The other thing is, again, this comes back to the thing that we want to focus on in simplicity. Let's just say that one of those charities you didn't like, and you wanted to replace it, or you wanted to not replace it at all. You just wanted to give 25% to 4 other charities. Why? Updating that just within the donor advised fund account, which you can do online very easily for most folks, if you do that update, it can be very, very simple. And then each one of those charities in that example would receive $25,000 instead of $20,000. So without having to update your will or your beneficiary designation from your IRA, you just logged on and you took one charity off and you reassigned the distribution levels to probably 2-3 minutes, and instead of going through all of the estate planning update that you might need to do otherwise.
Yeah, that's great. Okay, so the next one, number 6, clumping gifts together. Talk us through this one.
Well, and it comes back to what you said, Austin. With the standard deduction having been raised, we have fewer clients who itemize their gifts. Now, one of the ways that clients can itemize their gifts is they clump their gifts together. And so they may say, well, have a really significant level of income this year, and so I'm going to have additions above and beyond what would be typical to this donor advised fund. So they might fund 3 or 4 years worth of gifts and get that tax write-off in that year. That way they're far above and beyond that standard deduction, and they get to itemize in that one particular year, and then they just know that the next year or 2, maybe they are doing a standard deduction. So a lot of clients, if they're giving away $15,000, $20,000 on an annual basis, they may not be able to itemize. But if we clump those together, and now we've got $20,000 of gifts, and we put 3 years together, $60,000, now we're not just itemizing, but we're really far into that itemization. So it can be a really nice tool.
Yeah. Okay, so the last way to give that we're going to talk about today. corporate charitable sponsorships for business owners. Walk us through this one and how it's beneficial.
And obviously, we have a lot of folks who are not business owners, but for folks who are business owners, who are clients, this is always one that's great to explore because we can actually have them use their business income to be able to fund charitable sponsorships. So they say, okay, well, I'm going to give $5,000 or $10,000 or $20,000 to this charity, whether it be local or national or global. And they're listed in the group of sponsors, for that charity. And there may be some other, perks that come, with that, some level of recognition. But that comes out of the revenue of the firm, and it can be used as an expense there. So that can be a very tax efficient way to go if someone is passionate about the charity. They are getting some kind of marketing benefit from that corporate charitable sponsorship. But it's something, again, only a smaller slice of our clients could do because you have to be a business owner to be able to go through that.
Yeah. Well, great. Thank you so much, Spencer, for walking us through those important tax planning pieces, things to avoid, and the ways to give. Clients, if you're interested in talking more about giving charitably and how to do that within the context of your financial plan, we would love to have a conversation with you. As we often say, we are not CPAs. We are not going to get into the minutia of long-term tax planning. But you need to take these strategies to your CPA, take them to your accountant, talk with them, with your financial advisor within the context of your financial plan. With that, we hope you enjoyed today's episode, and we'll see you again next time. If you like these financial planning videos, please share with a friend, and if you have questions, go to our website at SeriousRetirement.com. This content was provided by Retirement Planning Services. We are located in Knoxville, Tennessee. You can visit our website at SeriousRetirement.com. The information in this recording is intended for general educational and informational purposes only, and should not be construed as investment advisory, financial planning, legal, tax, or other professional advice based on your specific situation. Please consult with your professional advisor before taking any action based on its contents. Advisory services offered through Retirement Planning Services, LLC.